Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's July 24th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So you see the latest news on Macy's? Started selling these dishes as a set. And dishes come with 3 circles on them. And the smallest circle is called skinny jeans. The middle circle is called favorite jeans. And the largest circle, and these circles are on the same plate, is called mom jeans. So apparently this offended tons of people. So they say, tons of people. And one person tweeted, "How can I get these plates banned in all 50 states?" Of course, tweet went viral. Everybody was up in arms. I say everybody, people on social media. And Macy's did what most corporations do, right? Came out, apologized, did the politically correct thing, said we're moving the product from all stores, said we missed a mark on this product. This comes on the heels of what we saw at Nike when they pulled all of its sneakers that had the Betsy Ross flag on it, right? So they pulled it 4th of July, Independence Day. They were beautiful sneakers, the Betsy Ross flag on the back of it. And we had one person, happens to be the biggest attention seeker since Kim Kardashian. He said the flag's design, which was created back in the 1770s to represent the original 13 colonies, that flag is associated with white supremacy and slavery. So even though 99.9% of the population does not see the Betsy Ross flag as racial or as a symbol of slavery, and that includes pretty close to 100% of the stories, including the Anti-Defamation League, who keeps a database of more than 150 hate symbols, and Betsy Ross flag was not on it, of course, so it didn't even surprise them. But what happened? Nike came out and said, "Hey, sorry. We got this wrong. We apologize." And they pulled those sneakers from the market immediately. Last month, St. Louis Park, small little city in Minnesota, said that in order to create a more welcoming environment to a diverse community, we're going to forego saying the Pledge of Allegiance before every meeting. So they came up with a vote and they decided to ban the Pledge of Allegiance because it's not welcoming to our diverse community. And they had, 5 people who were voting on it, 5 whoever people that they chose. And of course, every single one of them supported the ban. A lot of social media got involved. People came out and said, "Okay, this is BS. What are you doing?" Whatever. And they quickly changed their mind and said, "Well, we had to because we're getting threats and people are, we're scared for our lives," or whatever. But this is just 3 of hundreds of events we've seen over the past couple of years. That's pretty crazy, right? When you sit back and think about it. And as a country, I'm being serious here. I mean, we really need to get our shit together. We need to grow some balls. And if we're going to let less than 1%, much, much less than 1% of the population who are miserable, I won't curse, they hate life, hate themselves, wake up angry every day, complain about every little thing. I mean, that's what social media is right now, right? If you look at the angry posts on there, I'd say 70% are probably angry. If you look at Trump, who has the most followers, I believe, one of the most followers, I would say about 80% of them are negative, or people just bashing him. But it's all, anger, people pissed off. We're going to let these people dictate the direction of this country. I tell you, we're in a lot of trouble. And the apologies from Nike, from Macy's, who did nothing wrong. It's ridiculous. And wouldn't it be nice to see a CEO come out and tell it like it is? Don't be politically correct. Man, I would love Nike to come out and say, "Hey, Colin Kaepernick, this is more about you. than about our country. The flag does not offend 99.999% of people buying our products, so F off. And if you don't like it, then you know what? We'll end your contract. We'll fire you and stop paying you. But I look at this. I mean, Nike is paying Kaepernick. The NFL was paying Kaepernick. They have the right to rein this guy in. He's on their platforms. And it's freedom of speech, but if someone says that they hope that Hillary Clinton dies, you could say that. It's freedom of speech. But if someone works for me and says that, I'm going to fire them immediately because they're not saying that on my platform. They're not saying that at my company. So when you're working for these companies, you don't have freedom of speech to say whatever the hell you want. You do that on social media. But the fact that they give in all the time to these people is sickening. Let me tell you something. Because of Macy's, Nike, if they both said, look, we're not removing our products. If you don't like it, then don't buy it. You know what? They'll probably see a shitstorm of negative press because people love talking negative. They may lose a little bit of business, some business. But you know what? Saying something like that creates loyalty. It'll create loyalty to your brand, which is much more powerful than having customers who barely shop at your stores dictate what you should sell because they're offended. Such a big word these days. We're offended. I mean, I make fun of Peter Schiff a lot because I don't think someone who's been dead wrong for 10 years and lost tons of money for its customers should be criticizing anything. But he is a gold bug, and he has a massive cult-like following. He doesn't care about guys like me who, I've called out on Twitter many times. He won't apologize for anything. He doesn't care. And that's why he has such a loyal following. Doesn't matter. They just believe in him. That's fine. That's cool. I can't believe I'm kind of talking positive about Schiff here, but you get my point. He doesn't backtrack and says, oh, I'm sorry, Bitcoin, you guys are doing okay. I didn't mean that Bitcoin's going to zero. No, he doubles down. This is what he says, but that's how he feels. And I give him credit for that. There's so many people that back up, that always apologize for things that they shouldn't really apologize. Is it offensive? No. The Macy plates, come on, guys. Give me a break. You have to stick up for yourself. I mean, Nike should tell Kaepernick to go F himself. If he has a problem with that, again, just fire him. That's what builds loyalty. People love that stuff. Not apologizing for everything. Like the Macy's coming out and saying, sorry, we offended you with a dinner plate that says mom jeans. I mean, what's next? Are you going to ban all manufacturers of novelty tees? And do you ban the Pledge of Allegiance at all schools? You're going to ban everyone from drinking Coca-Cola or McDonald's because it's bad for you, even though it tastes great? It's not like the person who's eating these things that you so-called try to help because you're offended or whatever. It's not like they're not going to go to Taco Bell or Pizza Hut instead. Not McDonald's full and Coca-Cola. They just make something that everybody loves. Is it good for you? No. But people love and they keep buying it. Look, Coca-Cola's earnings, all-time high. Look at McDonald's, close to an all-time high. People love this stuff. But yet, it offends a few people. And with social media, you get things to go viral, and everyone's out there backtracking and apologizing. And it's terrible. I mean, I'd like to hear your thoughts on this. FrankCurzioResearch.com. Me, I'm sick of it. I hate it. I hate seeing stuff like this. Just speak your mind. If you're an ass, you're an ass. Be an ass. That's you. But don't create something like Nike, which was a beautiful sneaker for Independence Day, celebrating our country, because one idiot's like, oh, well, back in the 70s, that. I mean, come on. Give me a break. You're going to change? You're going to remove your sneaker? Do all of that? I mean, what kind of loyalty does that build? Because I can tell you there's a lot of people that are not buying Nike products because of that. But your most loyal followers, they love that. They want you to stick. They want to believe in your brand. But when stuff like that happens, when most people disagree with it, man, it's frustrating as hell. And it keeps happening and happening, and it's getting worse. When people get the word offended. People are offended by everything these days. With the feelings. Oh, you hurt my feelings. Big deal. Come on, give me a break. It's insane. Anyway. You say something, own it. the apologies and all this craziness and backtracking and stuff. It's just, for me, it looks terrible. Makes me not want to support your brands, not support those people who are doing it. But we really need to grow a pair of balls. And I hate to put it that way, but we do. And what's going on with this country? Even my kids, when I go to school and, we make sure everybody gets a trophy. Like she was in a baking contest. And before they came out, and it was like 6 groups, which, by the way, I loved it because it was 2 boys, actually. Look, it's a camp and I'm a parent, so I get it, right? You want some time. It's a summertime. You have your kids all day. So, the mother's like, I don't care. And 2 of the mothers put their boys in cookie camp who were like 12 years old. And, my daughter was in it too. And they're a team. And they came wearing basketball shorts, basketball shirt, and it's above the rim and stuff like that. And they made a cupcake. The boys made a cupcake that had lifesavers in it, Pop Rocks, and M&Ms. I loved it. That's exactly what I would have did. But that's what you get from boys. Anyway, before they came out, there was 4 judges who were young. They're like, okay, please don't try to offend them. But it was so worried about hurting people's feelings or offending them. But me growing up, that's what motivated me. When people said, hey, you're too fat to play basketball. You can't do this. You can't do that. There's no way. I love that word can't, because every time someone told me I couldn't do it, it made me want to do it. But today, you don't say that to people. You have to be nice. You don't want to offend them. And we all know that's not the real world. It's not. You're going to get eaten up like crazy when you get out there. It'd be terrible. I see that firsthand living in Florida. It's nuts. There's no accountability. Kids don't show up to do a job. They show up 3-4 days later. I mean, it's insane. The work ethic here is insane in this state. It is terrible. It's horrible. I thought I'd get used to it. I've been here for 10 years. I can't get used to it. People hate to work here. They hate it. It's not, they're on island time or it's relaxed. No, they hate to work. They don't want to work. They'll do everything they can not to work. I've never seen anything like it. Growing up in New York, we got to fight for your jobs. But anyway, this word offended and worried about what people think all the time. Guys, come on. Give me a break. Nobody's perfect. We're going to make mistakes. You're just going out there, removing product lines, and because it offends a few people and something goes a little viral on social media. Come on. A lot of that's trolls. A lot of that's garbage. Guys, got to grow a pair of balls because, man, this country, to me, it's not going in the right direction. I may be all alone on this. You may think I'm crazy. I have no idea what I'm talking about. Let me know, frankcurzioresearch.com. Sorry, I just had a rant about that. I just think it's funny. Macy's removing plates for a few people that are offended, and we've seen this happen with Nike. We're probably going to see it happen with more companies going forward, how just a very, very tiny portion of the population controls and dictates what so many of these countries do, what our politicians do. And you know what? It's pretty insane right now. Anyway, let me move on before I keep going and going and going, because I have an unbelievable interview for you today. My guest is a billionaire, legendary fund manager. Let me drop a few hints here. I'll give you one more. He's on TV a lot doing commercials where he rips apart and says, I hate annuities. Did you guess it yet? You should have. If you watch CNBC, you guessed it, because he's on there all the time doing commercials and also on there being interviewed. His name is Ken Fisher. Ken Fisher managed over $100 billion with his funds. He's been managing money since 1979 when he created Fisher Investments, regular columnist, USA Today, Financial Times. He was columnist for Forbes from 1984 to 2017, but that's the longest running columnist they ever had in the history of that company. He also writes for several international publications, authored 11 books, wrote Turner papers on behavioral finance. I mean, I keep going and going and going. And he's also credited, which I thought was pretty interesting, for being the first to use the price-to-sales ratio as a forecasting tool. Enough about the accolades, because it's going to be an awesome interview. We're going to dig into lots of great stuff, including why he is super bullish on stocks, on U.S. stocks. Talk about a little bit why he hates annuities, which pretty easy to find. You guys already know that. Don't want to get too much into that because I like interviewing people and getting things out of them you can't get anyplace else or read anyplace else, which includes me breaking down his research process and talk to him about how he finds his stock picks that make it into the portfolio, how all capital markets are integrated. He's going to talk about that. He's going to say how stocks make their way into the portfolio and how important it is to adapt to the markets. And that's what he's been doing. For example, past couple of years, his largest holdings, mostly technology stocks in the top 10. He's been doing great because he adapted. So really, really great interview coming up. You're going to learn a lot. Then my educational segment, I'm going to break down the latest results from iRobot, which were terrible, and why I think the company is still in big, big trouble, even though it's down around 20% today on earnings and down to $70 a share from $130 a couple months ago. Going to break it down and tell you why I still don't like that company, why you shouldn't bottom fish, and why it's probably going to go a lot lower. But before we get to that, let's bring in the billionaire, the author, the money manager, and the legend, Ken Fisher. Ken Fisher, thanks so much for coming on Wall Street Unplugged.
I'm delighted to be able to do it. Thanks for having me, Frank.
Well, I'm a huge fan. Not sure if you know this or remember, but I interviewed on my podcast, which was called The Real Story back then. And this is when I worked at TheStreet.com. I believe it was late 2009, if I'm not mistaken. And during that interview, you happened to be extremely bullish back then at a time where, most investors were deathly scared to invest in the markets, just coming off the credit crisis. I was surprised by your call. Turned out to be dead on. It was a great contrarian call. Now, how do you feel about the U.S. markets today?
Well, you can go on with that for 3.5 hours, but to make a long story short, it's a bull market, and the bull market has more to run, and it probably runs longer than most people think it does, but then it'll end eventually. It's a nice little world. It's almost in the mid-'90s, this kind of a world would have been referred to as a Goldilocks economy and would have been met with more optimism than we have today. John Templeton, had the famous line that bull markets are born on pessimism, grow on skepticism, grow on optimism, die of euphoria. And we're very clearly neither pessimistic nor euphoric. There's sort of a skeptical optimism in people's minds, and that tells you that unless some big, bad, terrible thing comes along that nobody sees coming at them, therefore is not free price, which happens sometimes but is very rare, we probably keep trudging along until we get to a more euphoric world. It takes quite a bit of time to get to from here because just turn around 3 times on Sunday and you can see that people aren't very overly optimistic in a broad sense.
So again, based on what you just said, you often talk about how news events, they're early priced into the markets, especially investors and the media talking about it. So, you're saying it's a bullish market. And when I look at that thesis of what you talk about, where it seems like, hey, if we're talking about trade that's factored in, geopolitics with Iraq should be factored in, even politics themselves should be factored in. So is there anything out there that you think could derail this or something that worries you where this bull market trend will change?
No. Isn't that a fast answer?
Good answer.
I look at all kinds of things, and there's nothing that I see in the short to intermediate term, which is all that markets price. Markets don't price very long term. I can see that derails this world. If you don't climb the wall of worry to euphoria, you got to have something big and bad enough to turn normal growth, which in our world is globally about, a little less than 3% maybe with a hair's whisker of inflation, in an $80 trillion economy, that's something, in the realm of over $2.5 trillion US dollars. From that growth, it needs to turn it into recession. I can't see anything that big that isn't widely bantered, pre-priced, digested to high holy heck. We still have a world that's looking for ghosts around every corner because the last downturn was big and bad. It scared people. That fear has caused people to be begrudging the whole bull market up. Therefore, we've had a relatively joyless bull market, so therefore it's been long. The longer it's ground on, the more people think it's going to die of old age. Markets don't die of old age. They never have. They never will. That's not what causes markets to end. And so you sit there and grind while people keep grousing about all the things that could go wrong.
Now, when I look at so say now you have the bullish thesis, right? You say, okay, I don't see anything derailing this for the next 12 to 18 months. Let's dig down to how do you play it? Because I look at some of the holdings in your portfolio and it's very technology growth weighted. Where when I look at a guy like David Einhorn, who I do like, and I don't like to talk negative about anybody, but he has a value style that hasn't been working for 5 years and refused to adapt. Talk about the methodology where, okay, here it's bullish. Now I'm going to invest in these. Is it valuation? Is it growth? Do you look at the macro, top down, bottom down? Can you take me through that process? Because it seems like it doesn't seem that way, but your portfolio right now is perfectly positioned for a bull market where you're heavily levered in technology, and these have been the best performing stocks, at least over the past 12 months.
So basically, I think in the following way, and I've thought this way for a long time. You start from a global top-down macro basis. You presume that the world is, in an economic sense, globally integrated, and that capital markets are heavily globally integrated, so that, for example, while America may do better or worse in a period of time in the stock market than the non-U.S. market, the big blocks are going to basically move the same direction. And then you start saying to yourself in sectors, that's true too. And then growth and value, big and small, that'll be true too. And then you start saying, based on where we are and what's going on, what are the categories of those that should be doing better versus worse? And then you plan to tilt your portfolio those ways. And then you start looking into the stocks that meet those categories. So I would say just basically that the nature of stocks that do best in the latter stages of bull markets are always categorically different than those that do best early in a bull market. And sometimes there's variation in country. But for example, value routinely does best bouncing off the bottom of a bear market, and the latter stages of bull markets are usually dominated by companies that could be categorized, and this sounds sarcastic, but it's true, categorized as the kinds of stocks that the last greater fool into the market would find himself or herself comfortable buying when just a few moments before they were too scared to own anything. So those uniformly, regardless of cycle, end up being big, broad household names where they've got some growthy qualities so that person can look off into the future 10 years from now and say, I think they'll still be there and they'll still be going strong. And those that do best in, sometimes that's been healthcare, sometimes that's been consumer discretionary, sometimes that's been tech, but then you start parsing down as to what would make that go further. And yes, in this cycle, tech's the dominant feature. In fact, this is a parse that most people don't do, but if you parse out tech categorically from the other sectors, Americans and foreigners as well naively believe that the American stock market is doing better than the non-American stock market. That's really only true because of tech. If you take out the tech in both sectors, for example, America and Europe have been doing the same, when most Americans will look down their nose at Europe and not get that the non-tech part of Europe is doing as well as the non-tech part of America.
No, it definitely makes sense, especially how big the tech companies and the market caps of how the largest companies in the world right now in the U.S. Now, a lot of things
not just right now. I mean, America dominates tech. The overwhelming degree to which America dominates tech is not fully fathomed, in my opinion, by most people in America. They just kind of take it for granted.
Now, a lot of the things you just cited in terms of, it could be healthcare, it could be consumer discretionary, depending on the time or the markets, and tech, which, lead the markets in bullish cycles. And I'm sure a lot of this has come from, you've been in the industry for over 4 decades. And I know that when I started looking at you and I follow you, I know that you really focus on historical patterns, also behavioral and stuff like this. Has your thesis changed on that, looking at historical patterns where, of course, you can look at historical patterns, and I know that you mentioned, third cycle of presidency, the market usually does well, so it's no surprise that it's going up right now. But has things changed to the point where you've heard this, and I'm sure you've heard this, I've heard it, where margins are supposed to revert back to the mean? I've heard that argument for 6 years, but yet productivity's through the roof where we have the internet now. Back in the day, my dad used to be in this business, my late dad, where you had to go to the library to get 10Ks, and now you could send something in a minute to the world. But does that change your historical perspective, especially bringing in more macro factors like, low interest rates for the first time at these levels, where you look at different data points to come up to this research? Has anything changed, or no, you're still using the same methodologies when it comes to tracking historical patterns?
So things never change and things always change. And intuitively, that's been the way it's been since, well, at a minimum, the Industrial Revolution. And in this period, and relative to the things we've been discussing, in my opinion, one thing's changed, which you're alluding to very directly, is the ease at which someone can recognize historical patterns. And I think when you think of history and what has gone on before us as a potential guide for future actions, you need today, which you didn't used to need to do a long time ago back in the day, that you refer to, that I remember intimately as a professional, when you had to go to the library to get it. You think of it in two different ways. One of it is, and Jeff Silk, who's been with me for over 30 years, coined this phrase ABC, which is anybody can do it. Anybody can. And so you say to yourself, what can you find out about all that stuff that doesn't apply to, where ABC doesn't impact? And the other is, what is it that ABC does impact that quite simply no one will believe? That it's just beyond the ability of the human to say, yeah, I accept that. So you're looking for those two kinds of things categorically. And the reality is that there's a lot of stuff that goes on in the world that history implies, but you can't capture in data. And then, therefore, it's no easier to get now than it ever was. On the other hand, and in reverse, there's things you can just flat out say, where if I shove it right in your face, you just won't believe it. So those are the ways you think differently about that. And I'm still a big believer in the notion that history can teach us huge amounts, but I also have the view that if it's easy to find the pattern and the pattern is believable, it's already priced. I mean, to your point of the way you raised the question, that part of it I think is categorically true.
Now, through this whole conversation, it seems like, and I don't know if you would contribute this to your success, and people define success a lot of different ways, considering you're a legendary fund manager and you've been doing this for such a long time, great returns, and been growing your business. But what are some of the things that you've learned? Because what I'm learning from this conversation is you always seem to be willing to adapt to new and changing times throughout your career. And I see that with a lot of fund managers, where even as men get older, they get stubborn in their ways and they don't change. But it seems like you're abreast of the market. You understand it's a growth market. It seems like you're ahead of the curve. What did you learn over the past years? Because it seems a lot of people that I interview fail to adapt to what the market's giving them, and it seems like you're adapting. You understand it's a bull market, and you're positioned accordingly. I guess I'm asking is, did that change over time? Did you check your ego at the door and say, hey, we need to adapt? Or is it just this has been your investment style the whole entire time since you started your firm? I believe it was in the late 70s.
So I don't really know the answer to that. I have things that I believe, but I'm not sure they're right. Let me tell you what I believe. I believe I was lucky to be born a youngest kid and to be stupider than my older siblings. And the younger and stupider part also implied that for a long time I was smaller and physically weaker and all that stuff. And what that always made me do is seek out what can I get in the face of stronger competition. And it is always true that when you're in the market, you're up against stronger competition. And I've known that from the beginning of my professional realm, and that I have to kind of be thinking about what is it they don't want that's good that they can't find. And when I mean that, I don't mean that just simply in a sense of business competition against my firm, for which that statement still applies, but also when you think about what, for example, Ben Graham would have referred to as Mr. Market. It's just what I've referred to in more recent decades as the great humiliator, whose goal is to humiliate you and everyone else for as much money as possible, for as long a time as possible, and in the most embarrassing ways possible. And your job is to engage the great humiliator without ending up humiliated by it. The reality of that is you have to keep thinking about the fact that you're up against this competition. Now, the other part that I've embraced before I started my firm is I was hugely impacted as a very young man by the power of the integrated circuit and metal oxide semiconductor technology. And in that realm, I saw this world changing, which we today refer to as, the effect, which is now fairly old and mature, of Moore's Law. And yet technology keeps changing things, and yet human psychology never changes. So you keep blending that part where the one part's changing, the other part's not changing, the one part's changing, the other part's not changing. That keeps going, and so you keep looking for the change. So in that regard, Frank, I'm actually stubborn. I'm stubborn and unchanging because I keep doing that same thing I've been doing now for, all these decades, which is don't change and change, don't change and change. That part about human psychology, it does not change. It's never changed in my lifetime. I don't think it will change. On the other hand, that other part about keeping looking for the new thing. Now, my fascination with technology there is not about my overweights to technology in recent years, because the time you don't want to be in tech is early in a bull market, but that's a different point. The part about learning about markets, seeing how things that are changing in technology and in culture change the way we should be thinking about the tactics is just purely tactical. If you stick stubbornly to old tactics in today's world, you get buried. And that should be obvious to anyone.
Yeah, no, it's well said. So once again, we're talking to legendary fund manager Ken Fisher. And if that name rings a bell for you, it's the guy that you see on TV a lot, which is going to go into my next question, because I know you've been doing your own commercials for a while. But the last few years, and you correct me if I'm wrong on this, but they seem to be a little bit more edgy, where not that it's coming from anger, but it seems like it's something that you don't like what's going on in the markets. And I know you expressed this, and I saw an interview where, a lot of these competitors do not put their clients' interests ahead of theirs. I noticed that your commercials like, hey, you hate annuities, this is what you should do. And, have you seen a change, at least over the last 10 years? Because for us, and I'm a newsletter guy, I've been in the newsletter industry for over 25 years. And, my late dad was a newsletter writer before me for 30 years. There's a big change in our business where, people do not have numbers behind their forecasts. It's crazy. And it's less focused on the consumer today than it's ever been, in my opinion, especially the financial industry. Are you seeing that as well? Is that leading to it? Because I noticed that commercials are a little edgy, but you're trying to say, hey, guys, this is the way you're supposed to do it.
I wouldn't go there. What I'd say is this. Our advertisements first, there's more advertisements. We do more advertising than we used to. But that's also because we're bigger. But they're also more bifurcated than they used to be. And I think the difference that you're not fully recognizing is the degree to which we've bifurcated. And let me describe that for a moment, if I may. The reality, quite simply, is that when we started doing what in the regulations under the Investment Advisors Act of 1940 are advertisements, they were direct mail. Which is direct marketing. And then we evolved over a couple decades back. And then we evolved beyond mail into other forms of direct marketing. And then we started eventually to do direct TV, which is the first ads that you would have seen. Then we evolved to create, a couple years ago, as opposed to direct marketing on TV, branded advertising on TV to stimulate the direct marketing. And the branded advertisements that you see are exactly not what you're talking about. The branded advertisements are, for example, that comparison ad where you've got 4 people and they talk about some do this, some do that. Mm-hmm. And they're not so edgy. They're more friendly. Then the ones that you see with my face now are the edgy ones, and the two balance each other out. So the annuity ones, yeah, they're edgy. You got that right. The ones that talk about the fiduciary standard, they're edgy. You got that right. But the totality of them is not more edgy because they're offset by the branded advertising ones, which are, to use a phrase in opposition to the edgy, are, because there's not a non-edgy is not a great phrase. They're just softer, and it's more of a total balanced picture. And if you take apart the pieces, as we've bifurcated, there's parts of it that are more edgy. Now, do I believe the part about annuities being sort of a social problem? Yes, we could talk about that if you wanted to. Do I believe that there's issues about the fiduciary standard? Yes, we could talk about that if you want to. But all of these are subsets. Now, the fiduciary standard, just on one little point, there's been a big deal about that made in the media now for a couple of years with the back and forth of the DOL standard that was refuted by the courts, as you know, and then just most recently the SEC's best interest standard that's just very recently introduced. And all of that has provided a lot of attention, which makes that a good backdrop to add in those ads. So we're just, in a sense, using contemporary phenomena that are going on as a backdrop to put in that specific ad. But, I'm not sure that you only do the ads if they work. The beauty of direct marketing is that if they don't work, you know it. If they work, you keep doing them, and they won't work forever because they'll all fatigue. Then you have to come up with a different ad behind that. I'm not that much of a marketing expert, but we got people who are pretty good at it. And one of the things I know about all these ads is you do it, and after a while, people don't want to see it anymore, and it fatigues, and you got to have a better ad after that to replace it.
Yeah, and you talked about the edgy part and the ones that aren't so edgy. And one of the things that aren't so edgy is one of the commercials I just saw, I believe yesterday, where you have an investment guide to a comfortable retirement. And I noticed that you've been doing a lot of commercials this way, where you're targeting individual investors, and I'm sure most of them are accredited. But normally you don't see too many large money management firms where they just focus on institutional money. So the fact that you are targeting that audience, I guess maybe you could answer this question. Those individual investors that do come over and say, okay, I want you to manage my portfolio, what are some of the biggest mistakes that you see? I mean, you look at portfolio and say, okay, this is pretty good, we just got to restructure a little bit, or you seeing these portfolios and saying, whoa, these things have to, for the goals that you're looking at, everybody has different goals. I don't want to get into too much of it, but just say the average retiree is giving you their portfolio managed. Are you seeing a lot of things wrong with that portfolio? Some of the biggest mistakes that they make that you could address when you have that portfolio under the Fisher brand?
So most investors actually don't buy. Most investors are sold. And in the world, there's a large universe of product salespeople selling all kinds of different products. And what you mostly see is people loaded up with products that really they don't need, that aren't really right for them. In maybe products that are okay if they were very small proportions of them, but often that's chasing heat because the stuff that's been hottest in the marketplace most recently is the stuff that's easiest for the product salesperson to sell. And so you typically see that as the biggest single mistake, or exactly the reverse of that. And the reverse of that is someone who, for Ian, sits on cash and just can't get themselves to take risk. With that client, you need to go through ultra heavy kind of triple dose of education. And by triple dose, what I mean is when you were in school, when everybody else was in school, the average student was average by definition. And in theory, although I'm not sure that applies in today's educational world uniformly, that person kind of got a C grade in school. And the really exceptional person got an A, and then you had, that kind of almost bell curve-like distribution that was supposed to be from A to F, and you know all that. So if you think of that average C student, the average C student didn't really learn that much of it
on the first time the teacher tried to teach them. And if you really want that student to get it, you got to kind of do it once, do it twice, do it 3 times, which is basically what a bachelor's degree in college does in almost any major. They take you through it about 3 times so you understand it more or less by the time you graduate, because the average student, when they take it as a freshman or sophomore in the basic class, doesn't really get it because they only get 70% of it. So then they take it again as a junior in a different format, and they get a little more, and they take it again as a senior in a different format, and they get a little more. You have to kind of do that triple dose of education with these people to get them to really understand how the parts of the motor fit together and how the motor runs. That's pretty much it.
Yeah, it's amazing because everything that keeps coming back to kind of like behavioral, right? Like they learn just even something simple that you just said, where it's 70% is the first time, then a little bit more than that after the third time. And you talk about behavioral finance so much, what I think gives you an edge, even looking at just allocation for a portfolio or how do you see the worlds and stuff like that.
The biggest enemy of most investors is themselves, and the second biggest enemy is a product salesperson that wants to prey on them.
That's definitely a good point. So I want to move on really quick. So I know we're running a little bit late here, and I know your time is very valuable. So you're a regular columnist in USA Today, Financial Times, Forbes, which a lot of people know from 84 to 2017, longest running, I believe, in history of Forbes. You also contributed 7 international publications, authored 11 books, including, I believe, the name of Superstocks, where you're credited for being the first to use the price to sales as a forecasting tool. Which I learned by doing some research. I didn't know. That's amazing. You're also written tons of papers on behavioral finance. It's a huge workload on top of running a very successful investment company. What keeps you so motivated?
Oh, I drink a lot of coffee. I've been drinking a lot of coffee for a long time. I like it black. That way nothing gets in the way of the caffeine.
That's perfect.
I like what I do, and I've always liked what I do. And if I didn't like what I do, I wouldn't do it, because I've been free to do what I want to do. I mean, that's the beauty of being a founder, formerly founder, CEO, now founder, executive chairman. But the founder running the place kind of gets to do what he or she wants to do. They got to do a lot of other stuff until they can get rid of that stuff, hand it off to somebody else. But you do what you want to do. That's the fun part. If you're doing what's fun, why would you want to quit doing it? So you just keep doing what's fun, and then you get up in the morning and you're excited to do it. That's what keeps me motivated. That, and every morning I drink coffee.
No, it's great to hear someone who's been in this industry for such a long time that he's still so passionate about it. You can tell by just all the things that you do for someone who could have retired a long time ago, and going out there and really helping and teaching a lot of people out there. So, real quick, a lot of people see you on TV. They know you're a money manager. They know you're a legendary fund manager. You've been around for a while. I don't think people realize that the philanthropy part with you and your wife and donations and stuff like that. Can you talk a little bit about that? Because when I learned about you and how much, just the giving part and so many different places that you guys care about, it's pretty impressive, and nobody really talks about that. And I just want everybody to understand that you guys do a great job. Could you just give us a little insight into that? Because it's pretty amazing when I started doing research.
I actually disagree with all that. I'm not a giving kind of person at all. I'm a mean, nasty, ugly son of a gun. My wife, she gives away money sometimes, but me, I'm opposed to anything other than creating jobs and working hard and grinding people's noses off at a grindstone and stuff like that. I'm a big fan of grinding people's noses off at the grindstone.
Definitely a big fan, yeah. But you have donated to several things, and a lot of them have your name on it. But I think you're being a little bit modest there, and I understand. Yeah, you don't really want to give the certain things, but just the research
so
I've
generally,
seen.
Categorically, and this is one that gets me into trouble whenever I say this in public because it's antithetical to our culture. I'm not a fan of philanthropy. I basically view philanthropy as mostly a bad, not a good. It's not as bad as many other bads, but for the most part, and I learned this when I was very young, the capital markets pricing mechanism generates efficiencies for the benefit of humanity as capitalism evolves, providing income and wealth to people in a broad spectrum, despite all of that talk about income inequality, etc., in ways that are better in the intermediate to long term for people than philanthropy. When my wife and I have given away money, I always feel a little guilty about it. And I got to believe when we give it away that we know enough about the topic matter that I don't think we're giving away so that it will be bad enough relative to what would happen if I more or less left the money in the capitalistic system for the capital markets pricing mechanism to generate efficiency through some process, like having it end up in a venture capital firm with starting a lot of companies, or ending up in a place where somebody that's got a little business someplace gets a loan and then hires more people and creates the greatest thing since sliced bread. That's the next Amazon or whatever. Not that I can control those things specifically, because I cannot, but the capital markets pricing mechanism does it for me more efficiently than any benefits that come out of philanthropy as you look at philanthropy overall. As John Rockefeller said, philanthropy is really a difficult thing to do well, and most people take it way too lightly as a good. It's actually, if you just give it away, it's mostly a bad.
Yeah, you definitely want to know where the money's going, at least. That makes sense. So, Ken, listen, I want to thank you so much. I really dug down into picking your mind about your investment style, how you've been so successful. Hopefully that was okay. It's a little different from what I've seen with your other interviews, but I know that's what my audience really likes to see. They're investors. A lot of them are credit investors. They want to learn more. So I appreciate you coming on. If anybody wants to
do a great job, Frank. Thanks for having me. I'm pleased. I'm happy. It's easy. It's easy to talk with you.
Thanks so much. So if someone wants to find out more information on you, Ken, how could they do that?
Well, I think if you do a Google search on Ken Fisher, it's not that tough to do.
And if they want to get some more information maybe about your investment fund to invest in it, how could they do that?
I think they could probably do a Google search on Ken Fisher and figure out the firm that Ken Fisher works at, and then go to its website. It's not that hard to do.
Ken, you are an expert.
We've always tried to make it easy for people to figure out where we are.
Every extra step people have to do seems like they drop off. So I hear you, but it will be very easy to find it if they do a Google search. So Ken, thanks so much for coming on. I really appreciate it. And hopefully you join us again soon.
Thanks for having me, Frank. It was great.
Man, I love that interview. I mean, Ken speaks his mind, right? This is his personality. But I wanted to give you a picture of how a billionaire thinks. Because most billionaires I interviewed, sometimes they may not be the best conversationalists. Most of them, probably all of them, are super confident, so they may come off as arrogant. Not that, Ken came off as that. But I love the fact that he speaks his mind, and he does. And you go see some of the quotes I even pulled before the interview. I mean, he goes out there, calls people idiots who've been talking about inflation, more money's coming into the system. Where is it? Show me. He just really goes out there now. And that's what I was talking to about advertising. It's a little bit more edgy. I love that you talk about the fiduciary responsibilities, right? Because we do see that where it's more about, in my world, in Wall Street, it's more about profits and what they could do for themselves more than putting their customers first and their best interests ahead of theirs, which I know, especially when I see crypto and things like that. I mean, it's not the case. People are just looking for money grabs in a lot of different industries. And it's not that difficult to get them legally. I mean, look at the short sellers. I mean, Spruce Capital came out and said, tomorrow we're going to short, and this is Tuesday, we're going to come out with our best short recommendation ever. Kind of said that. They said, it was one of the most investigative research that they ever did. And, and they said, we're going to come out with it tomorrow. And they put that out on so many different sites. And what that means is, we want to increase our short position before we put this out, and which is legal, guys. And we have to contact the 25 lawyers that are going to launch investigations on this company 1 second after we publish the report, which I don't know how they do that since they didn't get a chance to read it, but they're all going to come out with investigations on it. Then they could say, okay, let's go to all of our media channels. This way they're going to publish this at the same time. And they just get everything ready, and, the stock's going to fall, whatever. I think it's 5, 7, 10%, sometimes 20, 30%, depending on how crazy the report is. They're going to say that the company's going to zero, which is not true. It's probably about 20, 30% overvalued, but they get away with it. And then they cover their position, if I would guess, in a couple days, maybe a week or something, while everybody's still short, thinking, oh my God, this is going to zero. And then they'll go on CNBC and no, we're at that position. It's legal. They do it. They take advantage. That's the market. That's what I was getting to with Ken. It's crazy out there. Quick money grabs. But what I wanted to capture in that interview is how not just can, but billionaires, they have one thing in common. They look at the world differently than everyone else. At least the billionaires that I've gotten to, probably up to like pretty close to 10 now, maybe 8, 9, 10 around there. Have to go back of people I know who are billionaires. Also guys I interviewed in the past over my career, probably more than 10 I've interviewed and spoken to, but they just look at the world differently than everyone else. How when I asked him, do you see anything derailing the U.S. economy? He said, no. Just no, which I thought was great. And he said, hey, you like that answer? Yeah, but come on, get into it a little bit more. But you don't see anything derailing the U.S. economy? There's nothing. There's not a terrorist attack. There's not a crazy geopolitical event. Again, it's things that we can't see. I mean, Iraq, anything which pushes oil prices to $100 again, maybe that. I mean, there's nothing. There's got to be a few things that worry you, I would think, as a fund manager. For me, I'm always when I'm bullish on something and he's bullish on U.S. For me, I always look and say, okay, what's wrong with my thesis here? But that was an interesting answer, I thought, and it's a good answer. That's him. But he's super focused, very brilliant. Again, I love how he talked about adapting to the markets. But I really like Ken. He's a guy I grew up watching. Since he was one of the few people on CNBC the 80s and 90s where you had about 15, 20 people on. My dad was on back then. It was Louis Navalier, Abby Cohen, Mario Gabelli. My dad used to go to the Money Show back then and see a lot of these people. But just to see, from 20 years ago, 25 years ago, knowing this guy very well, and now he's managing $100 billion. I mean, it's pretty incredible to see that growth. Definitely doing something right, and I really appreciate that he came to the podcast. But I say this all the time. The podcast is about you. It's not about me. So let me know what you thought about that interview. FrankCurzioResearch.com. That's FrankCurzioResearch.com. Now let's get to our educational segment. So yesterday, which is Tuesday, iRobot reported earnings, which are pretty good. But their guidance fell well short of estimates. I mean, they really lowered guidance for the full year. So you're looking at earnings that came out 25 cents a share, was 7 cents better than estimates. Revenues rose 15% year over year. They fell below estimates. But the company said that for full year 2019, they're expecting on average around 270 in earnings, which was much, much lower than the 315 to 340 a share that they were expecting. I mean, holy cow. That's a really big difference. So the stock is getting hammered today, down 20%, now trading at 70, which is kind of crazy because the stock is trading over 130 less than 3 months ago. Now, here's why I'm bringing this up, because this was a company that I told everybody to avoid. And the reason why I told you to avoid it, in all fairness, I've been saying to avoid it probably for 2 years, probably for about 12 months, 9 months or so, especially when I came back from the Consumer Electronics Show. I mean, the stock was running up. But when I went to Consumer Electronics Show and I look at iRobot, most of its sales come from those robotic vacuums like the Roomba. They come out with new versions of them. Their margins are close to 50%, which is unheard of for hardware, for products unless you're Apple, right? Who maintains their margins, which is incredible. And people just love paying, $1,200 for phones. And they buy them every single year, apparently. But Apple's great at doing that. They're one of the few companies. You look at semiconductors, it's kind of a commoditized space, most of it. Because once you create something, it's easy to create similar products, and you're going to, margins are going to get cut. And what is it that Bezos says? Your margins are my opportunity. Well, we have margins of 6-7%. I'm sure Amazon's not going to go after any businesses, but when you have margins of close to 50% selling a hardware product, you know what? That opens up the door to competition. Last 2 years, I've been to the Consumer Electronics Show. I've seen more than 10 companies and probably more than 15 companies selling similar vacuums that were better, that they were displaying right in front of us, that were selling at 30-40% cheaper than Roomba. And remember, that's where they received the most revenue from. Not to mention, not only these things clean rugs, they had ones that you put on windows. Talking about skyscraping windows, same thing, picture that Roomba-like thing, and it sticks to the window and cleans the windows. So it's like a new generation. I know iRobot's launching more products, but for me, when I saw these new products, it was like GoPro. GoPro is the same thing. GoPro is it's a great brand. People love it. But The CES is an international conference where over 4,000 technology companies showcase what they're going to release for that year, and it's in January. So in those products you can't even buy yet, a lot of them. I'd say 80% of them you can't buy yet. They're going to be released sometime in 2019. Well, when I went to see GoPro, there was at least 50 companies selling these 360 cameras that did the same exact thing that were selling 60, 70% below GoPro. And what happened to that company? Same with Fitbit. I mean, there's probably 500 companies that are selling wearables that check your heartbeat and all this stuff. And again, so you see this by getting out there. And that's why I said, listen, iRobot, guys, these guys are going to be in a lot of trouble. I was surprised the stock ran up so much. Stocks could keep running and running and running. I mean, Enron kept going higher before I had business. I'm not saying it's going to happen to iRobot, but what really pissed me off is the reason management gave of why they lowered their guidance. And they said that although we achieved our U.S. revenue target in the second quarter, again, you're always going to throw in a positive when it's a press release for a company, especially during earnings season. They wanted to say, we believe that direct and indirect impacts of the ongoing U.S.-China trade war and the recently implemented 25% tariffs are likely to constrain U.S. market segment growth in the second half of the year below our expectations, at least at the start of 2019. To me, that's horseshit. The trade war has been going on for 18 months. Okay, over this time, we've seen lots of companies adjust their supply chains, moving a portion of their operations to other countries, finding any way to de-risk the China situation because it is a risk. And yes, they're meeting in person. And I said, listen, I'm surprised it lasted this long, but there has to be a solution unless China just wants to have a massive setback of all the economic gains that they've had over the past 20 years. And if Trump wants to become president, because he's running on the economy, if we do not get along with China, it is going to impact our markets like we saw pretty much at the end of last year from September to December when the markets really fell off a cliff. So I think something is going to be done about this. But when you had the president tweeting and saying, oh, this is great, I had great talks. Oh, talks broke down. Oh, it's great again. Oh, you don't want that uncertainty, especially with your company. You want to de-risk as much as you can. Remember, uncertainty is the death of all stocks. It's the worst thing when you have uncertainty. So a lot of these companies are smart that they've been moving their operations, which iRobot saw this coming 18 months ago. The whole world did. At least 12 months ago, and did nothing about it. But I have to tell you, it's not China and it's not tariffs that are hurting this company. It's the competition. I mean, it's evident in the quarter. Their margins now 47.1%. They fell to 45.4%. Guys, that's a massive, massive fall in margins. That's huge for year over year. But what does it tell you? Right? Those profits are shrinking. There's competition coming in. That's a major setback right there. And like I said, how do you generate such strong margins on a hardware product? I mean, Engadget came out with a story from last week and said that they refurbished a Roomba, which is in great shape and provide warranty, whatever. But they're selling for $250, half the price for refurbished. And you could say that about so many different products, but I mean, you're looking at they're making such high margins on this, and there's so much competition coming to the markets where you're going to start seeing a lot of these products, which are being made in China or across Asia at much, much cheaper prices. Well, they're going to hit Walmart and Target soon. I mean, you want a good example? Man, I forgot the name of this pizza. It's something like Jack's Pizza, whatever it is, but they just started selling the frozen pizza. It's a nice little circle there. It's not even in a box. It's cheap plastic on it, cheap cardboard on it. But Walmart just started selling these pizzas for $2.50. How is that possible? I mean, you look at DiGiorno, you're looking at Ilios, you're looking at all these other things. But what Walmart wants to do is sell the most products. So Walmart's obviously getting like a lot of money off of that, but they're always looking of how they can make the most money. How could they sell more devices? So if you have Target that's selling the Roomba and all of a sudden Walmart signs a deal with a competitor who has a better, based on reviews, a better product, and they're going to be able to sell it 30% cheaper, well, where are you going to go? You're going to go to Walmart, you're going to go to Target. And then Target's going to say, okay, look, we got to offer this as well. And that's how it happens. But when you have that big of margins and your revenue comes from that product, like a GoPro or Fitbit, where it's low barriers of entry, very easy to make similar products, man, you're looking at a company that is going to get smashed. And they're coming out with new products. It's not the worst company in the world, but it's still expensive even at 70. And you know what? It's not tariffs. They could blame tariffs. They had plenty of time to adjust. I mean, you have VF Corp saying, they're okay with China with sales surging. Skechers was okay with China. Caterpillar said they're moving operations out of China to adjust for tariffs. You've seen people mention it now, where the quarter before they were saying guidance doesn't include tariffs. Well, over the past 3 months, they're finally making adjustments like good corporations do. They look ahead. All right, let's de-risk this China situation. This way we don't have to worry about what's going to happen depending on what mood the president wakes up and how he's going to tweet that day. So there's a couple of points here because iRobot's a company I've been telling you to avoid. The stock is down. I'm not here to pat myself on the back. I'm here to tell you that when you get out there and you have that boots on the ground research, that's how you find the best ideas. Sometimes that idea is going to be to short something. Sometimes it's going to be to long something. You're going to see people just lined up for a certain product around the block, being like, I love this, I love this, I love this. And the next thing you know, it goes viral. But that's why when it comes to things like this, listen to your kids, especially if they're teenagers. They know the biggest trends. That's how I knew Instagram was a great company. When I looked at the numbers, I was with everybody else saying Zuckerberg's crazy. And within a week, with the emails I've got because of this podcast, with people emailing me from colleges, from schools, and just the millennials saying this is everybody uses this is great. That helped me out tremendously. I mean, because I was one of the I don't want to say I was one of the few. I hate saying that, but everybody thought that was a horrible acquisition. I was like, hey, you know what? I don't think this is going to be a horrible acquisition because of the data I was getting from people. So get out there, go to conferences. And even when you're going, if you're going on vacation, when you get in a cab, talk to the cab driver. How's business? What's going on with construction? I do that with Vegas. It's more busy in Vegas than it's ever been, ever. But I hear so many people, the economy's weak. It's terrible. It's not. You go out there, it's not. People are spending money like crazy. When that changes, we'll see the trends. I'll see the trends. And that's why this podcast is cool, because I have so many people, and I get business owners and millennials and retirees. But when you look at things like that, that's how you find the best ideas, especially before everyone else, by getting out there. And by going to Consumer Electronics Show, this is one of the ones I said, hey, guys, this company is going to be in trouble. I don't know when it was going to happen, and probably happened a little bit sooner than expected, but it's not tariffs. They should have talked about the competition and how they're going to address that. That's what I want to hear, because you're always going to have competition enter the market. You're always going to run into problems as a business owner, but you want to get ahead of those problems. And they're not ahead of the competition yet, which scares the hell out of me. And it just scared the hell out of you if you still own shares of iRobot. Okay, guys. Whew. Long podcast. Great interview with a billionaire, right? Ken Fisher, which is awesome. And by the way, guys, next week, I'm going to be interviewing another billionaire. Not going to give that away. One thing I will say is I'm going to thank you, because I didn't reach out to them. They reached out to us, because the platform is getting bigger and bigger because of research, and Wall Street Unplugged, because more and more listeners are coming. People are starting to talk about the podcast a lot more. We're going to start marketing it now. Again, we are going to be kind of like a publicly traded company. You're going to see us market the podcast a lot now, because a lot of our business flows through. When people listen, they tend to buy our products and newsletters and read our research, which is, I feel, is second to none out there. But it all starts with you, because of that following where, 20 years ago, I didn't think billionaires were going to reach out to me to see if they can come on my show, which is cool. It's usually you're reaching out to everybody, say, hey, you want to do this, you want to do this, you want to do this. But that's the power of this podcast. That's the power of this network. And it's all of us in this together, guys, which is awesome. And we all want to learn. We all want to try to improve our generational wealth, make sure our kids are fine. We do that by having a massive network, getting ahead of trends. We've been doing that for a long time. And I just want to say thank you, because the guests that are reaching out to us now are very, very high profile. And the only reason why they're reaching out to us is because of the following, because it's a big platform, and it's big because of you, and you guys listen to it. So I just want to say thanks. So that's it for me. Thank you so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.